Welcome to this Nedbank Financial Market Educational Series, proudly brought to you by our online share trading division. In this educational series, we will discuss key financial market ratios. Fundamental analysis relies on extracting data from financial statements to compute various ratios. Ratio analysis refers to a method of analyzing a company's liquidity, operational efficiency, and profitability by comparing line items on its financial statements. Ratios can be an invaluable tool for making decisions about companies you might want to invest in, and learning about such ratios is essential for every client as this will equip you to make more informed personal trading and investing decisions. Please note that this session is on both a beginner and intermediate level. Please refer to our disclaimer. In summary, you cannot regard this session as any trading or investment advice. This information has been provided for educational purposes only. Let us start this session. First, let's define what financial market ratios are. A financial ratio or accounting ratio or market value ratio is qualified magnitude of two or more nominated numerical values taken from a company's financial statements. We will use the phrase ratios going forward. Frequently used in accounting, there are many standard ratios used to evaluate the complete financial condition of a company or other organization. In other words, ratios are relationships determined from a company's financial information and used for assessment purposes. Ratios can therefore be used to evaluate the current share price of a publicly held company's shares. These ratios are used by current and potential investors to determine whether a company's shares are overpriced or underpriced. Now we can explore different types of ratios. There are various aspects that the company management, investors, and the board of directors need to look at for investment or management purposes. The ratios help in determining what decisions need to be taken strategically or from an investment point of view. Ratios also help identify areas of improvement and can highlight how the company is performing compared to its competitors and itself over time. We will cover some of these ratios in more detail, but first, let's highlight the different types of ratios. The most common ratios used can be grouped into broad categories, such as profitability, liquidity, activity or efficiency, solvency, market prospect, and capital budgeting. Before we discuss the different ratios, let us briefly highlight how these ratios are calculated. Ratios are calculated by dividing one number by another. Usually, these numbers are financial figures or balances that can be sourced from a company's financial statements. Financial statements refers to the balance sheet, income statement, and cash flow statement. Virtually any financial figures can be compared using a ratio. It is important to bear in mind that ratios are time-sensitive. They can only present a picture of the business at the time that the fundamental figures were prepared. Ratios should be viewed as aids to judgment. Experience in reading ratios and tracking them over time can assist any manager or investor to improve. Ratios can also help to identify areas in the company that need attention before potential problems arise. Let's discuss the various types of ratios in more detail. First up is profitability ratios. Profit arises when revenue and income are greater than the costs and expenses. Therefore, these ratios indicate how well the company manages its expenses and how much profit it generates from the given level of revenue. There are various ratios that fall under this umbrella. Gross profit margin, which equals gross profit divided by net sales. Operating margin, which equals operating income divided by net sales. Net profit margin, which equals net profit divided by net sales. Return on equity, which equals net profit divided by shareholders' equity. The shareholders' equity figure used can be an end-of-year figure or an average figure, depending on the need of the analysis. And finally, return on assets, which equals net profit divided by total assets. The total assets figure used can again be an end-of-year figure or an average figure, depending on the need of the analysis. Now let's look at liquidity ratios. These ratios measure the amount of liquidity available within a company. For example, the amount of assets that can either be quickly converted to cash or are in the form of cash and cash equivalents. Liquidity ratios indicate a company's ability to pay its current responsibilities. There are various ratios that fall under this umbrella. Current ratio, which is current assets divided by current liabilities. Quick ratio, or acid test ratio, which is current assets minus inventories divided by current liabilities. And cash ratio, which is cash and cash equivalents divided by current liabilities. Next up is efficiency ratios, which are sometimes called activity ratios. These ratios define how efficiently the company is using its assets and other revenue-generating resources. They include asset turnover ratio, which is net sales divided by total assets receivables. Turnover ratio, which is net credit sales divided by net receivables. Here, the denominator can be an end-of-year figure or an average figure, depending on the need of the analysis. Average collection period, which is accounts receivable divided by credit sales times 365. 365 days can be adjusted to 360 or any other number as per requirement and convention. Degree of operating leverage, which is the percentage of net operating income divided by the percentage change in sales. Days of sales outstanding ratio, which is accounts receivable divided by total annual sales times 365. Average payment period, which is accounts payable divided by credit purchases times 365. Solvency ratios measures how much debt can be recovered from the resources available to the company. If a company has insufficient resources to cover its debts, it can be declared insolvent. Debt ratio, which is total liability divided by total assets. Debt to equity ratio, which is total debt divided by total equity. Times interest earned ratio, which is earnings before interest and taxes divided by interest. Expense debt service coverage ratio, which is net operating income divided by total debt service ratio. Market share or valuations ratios are used to evaluate the current share price of a company's shares. These ratios are employed by current and potential investors to determine whether a company's shares are overpriced or underpriced. These ratios include EPS or earnings per share, which is net income divided by total number of shares. Payout ratio, which is dividends divided by net income. Retention ratio, which is 1 minus the payout ratio. PE ratio, which is the share price divided by net income. Dividend yield, which is dividends declared divided by the share price. Lastly, there are capital budgeting ratios. Capital budgeting is a technique for evaluating projects. Some widely used capital budgeting techniques include net present value, benefit to cost ratio, internal rate of return, payback period, and accounting rate of return. The formulas to calculate these ratios are quite complex, and we won't be covering these details in this presentation. By now you're probably asking yourself how important these ratios are. Well, in general, their importance can be categorized into two areas. Important for internal users such as the management or the board of directors, and important for external users, such as shareholders and prospective investors. Ratios important to internal users would include the activity ratios, while ratios such as the market or evaluation ratios are more important to investors and shareholders. Other ratios such as solvency and profitability are equally important to both the internal and external users. Ratios mostly help in comparative analysis in the peer group or time series analysis, or even in trend analysis to measure where an area is declining or improving. Ratios can help investors decide whether it is worth investing in a company or not. In summary, although they may seem intimidating at first glance, all of the ratios we have mentioned can be calculated by comparing numbers that appear in the company's financial statements. Financial ratios can be an important tool for companies to measure their progress towards reaching company goals, as well as how they compare with their competitors. Ratio analysis, when performed regularly over time, can also help companies recognize and adapt to trends affecting their operations. Yet another reason companies need to understand financial ratios is that they provide one of the main measures of a company's success from the perspective of bankers, investors, and business analysts. Often, a small company's ability to obtain debt or equity financing will depend on the company's financial ratios. Despite all the positive uses of financial ratios, investors are encouraged to know the limitations of ratios and approach ratio analysis with a degree of caution. Ratios alone do not give all the information necessary for decision making. They can provide useful insights into a company, but they should be paired with other metrics to obtain a broader picture of the company's financial health. We have reached the end of this session. This educational video was brought to you by Nedbank Online Share Trading. Any examples used in this session are purely for illustrative purposes. Thank you for your time.